Welcome to the Home Buyer's Money Map series. Today we are looking beyond the purchase itself, focusing on the ongoing cost of owning a home and basically how to have a secure financial future in your home. So you now got the keys, but what are the other financial responsibility that comes with basically owning a home in BC or elsewhere as well? You know, owning a home is a big responsibility. This is our final destination in terms of our financial roadmap to owning a home. So I have here with me, as always, Damon from Pilot Mortgage Group to help us kind of navigate through the beyond closing. So what are some of the financial responsibility that people are sort of looking at after they actually purchase the home?
Yeah, so obviously you have a mortgage payment, so that's one, and hopefully you've had a chance to discuss with your lender or your mortgage broker about that payment. Maybe you've even taken it one step further and worked that into a household budget to make sure that you're comfortable with it. But there are a few other things that you maybe didn't have, or you probably didn't have to pay before. Property taxes, that's one. You have to pay that one, and so that's to the municipality. That can be split up, so maybe you pay it monthly with the municipality, maybe you pay it biannually, depending on whatever their specific structure is, and you can cover that off. Strata fees, if you're buying into a condo building, you'll always have some sort of strata maintenance fee, and that's basically, you know, covers all of the ongoing maintenance of the property to make sure that, like, you know, anything that needs to be fixed, management, other things that need to take place in the building, everyone's sharing in that.
Yeah. In an apartment building, basically every unit comes together to kind of maintain the structure of the building and the common area. So that's what your strata fee goes into. Yeah.
You've got utilities. So 100% in BC, you're always going to be paying BC Hydro. So that's your electricity. If you have gas, you might be paying to Fortis as well. So that might be another component that you'll have to pay. You know, there's obviously other things that maybe you have a water, if you're buying single family detached home, you might have a water meter as well that you're going to be paying for separately, sometimes not, maybe it's embedded into your property taxes. And then home insurance, that's, you know, another crucial element that you need to have. The benefit of home insurance is, well, one, if it's a single family detached home, you need to have it because the lender is going to require it in case the home burns down. If it's a condominium, the real big key benefit to having home insurance for a condo is in the event that there was any things that happened in the building that you had accidentally caused, like a flood or a fire, you may be responsible for paying the deductible for the building's insurance, the strata's insurance, to replace all of these units that were damaged or all this stuff that was damaged as a whole, not just your unit. And so those deductibles are like astronomical now. They've come up quite a lot.
Yeah.
So that's something that really the strata insurance, or like the home insurance, is really going to be able to protect you against.
Yeah. So it's also important especially if you're in strata, it's important to actually keep in touch with your insurance broker and update them every year, because like your condos or your strata insurance changes every year because they also have to kind of get their own insurance. So your deductible might change. And then I've had clients or even myself that were perhaps their home insurance actually doesn't cover all the deductibles. So you actually have to get supplement ones in order to kind of like make sure that if something were to happen, either fire, earthquake, or flood or anything like that, that you don't have to pay out of pocket. You will have to pay your deductible, which might be like maybe $1,000, $2,000, but the strata's deductible might be like $200,000. So you need insurance. Basically, you're paying deductible to your insurance, and then your insurance need to pay deductible to them for basically the policy to trigger, so then everybody is protected that way. Yeah, and then owning a home, you're also looking at kind of maintenance in terms of if you have a detached home, you got to do your own. You maintain your own roof, clean your roof, or if you need to renovate. If there's anything cost that's associated to basically maintaining your home and keeping your home kind of like livable, as well as you know, you want to keep this for a long term. Again, it's like the biggest investment you can have in your life, right? So you gotta have sort of like, you almost want to kind of create a different account and then every month put a little bit of money into it as your own insurance, because these are things you have to pay. Strata is pretty similar as well, because you want to put away, for example, money for special levies sometimes, because that definitely comes up. And special levies, for those who probably live in a strata, is basically like, this is the same with like a home. You might have to maintain the roof, you might need to redo the roof and everything, so you got to put money into it. And normally your maintenance fee is just for the operation of the building, right? And then occasionally when you have big items like roof or elevators, as owners, everybody needs to put in a little bit more money into it, so then they can basically maintain the building. So those are kind of the costs you're looking at. So we want to talk about your mortgage statement a little bit. And so this is probably, we also want to explain a little bit of principal and interest, and then especially for those who might actually have the money to actually invest. Why is it so important to kind of understand your mortgage?
Totally. Yeah. So, usually when you're buying your first home and they tell you, like your mortgage broker or lender tells you, this is going to be your payment. You're like, okay, I can handle that. But what are you getting out of that, right? Like let's say you've been renting, right, and you've been paying rent, are you getting anything back from that? Probably not, right? Like you're basically paying the cost of just being able to continue to live in that place. With mortgage payments, however, the expectation or the intention is that you're going to pay this thing off in some point in the future. That's the amortization period we talked about. So like pay it off in 25 years. So the payment is going to be a combination of principal, right? Paying down the mortgage so that you actually own more of your home to yourself. And then interest, that's the cost that you pay to the lender to be able to borrow the money. And so you want to keep an eye on this, because as you're paying more principal down, or as you're being able to accelerate the repayment, that's going to become less interest you end up paying over time. So like it all kind of works together. You also have, with most lenders, the ability to make extra payments towards your mortgage. So if really, like I've got some clients, they're just like, oh my God, all I want to do is get through this thing. Like I know I set it up to be paid out over 30 years, but I want to pay this thing off in 15 years. How can I do it? We'll show them the roadmap on how to do that. But we'll also tell them like, hey, you can do this, but like if what you're doing is you're actually incurring more debt on your credit cards or your lines of credit, you're not actually getting ahead, you're actually getting further behind. So we want to make sure that you're doing it the smart way. You're paying the most important things first, which is the higher interest rate debts. Then you can put that money back towards your mortgage, pay it off faster, pay it and end up paying more principal and less interest over time.
Yeah, because in terms of borrowing, actually mortgage is probably the lowest way you can borrow.
Lowest cost borrowing option ever.
Yeah, and then the next thing probably is the home equity, right?
Yep. So home equity lines of credit, so that's another option as well. If you've got enough equity in your home, so not necessarily the thing that most first-time home buyers can take advantage of, but maybe you're at like the 10th year of owning your home, it's gone up in value, you've paid down some of your debt, you might be able to borrow some money back from it in the form of a home equity line of credit. These are really great because you can use it for whatever you want and pay it off whenever you want. So if, let's say you're like, hey, I do want to buy that boat. Oh, I do want to buy that car. I want to invest in a recreational property, an investment property. A home equity line of credit is a great option to do it at a very low cost or a low borrowing rate. And you don't have to tell anybody why you're using that money. You can use it for whatever purposes you want.
Yeah, and basically, what is the kind of like the process of getting a home equity kind of approved? And I know it's a revolving, because you can just borrow it and then put it back, borrow it, put it back, and you don't need to check in with anybody. But what is the kind of involved in getting that?
Yeah, so it's the same as when you originally got your mortgage. So they're going to do an application with you. So collect your application information. They're going to collect your documents to make sure all that stuff is aligned from what you told them. And then they're going to do an appraisal of your property to make sure it's worth what you think it's worth. And then it's usually the appraised value times 80%. So that's the maximum that they'll be able to lend up to, less the mortgage amount you already have outstanding. That's the calculation that you would use. From there, that's going to tell you how much you'll be approved for based on the equity. You have to still have the income to be able to qualify for it. So that's one thing that you'll need to calculate. But from there, that's what you're going to be able to access. Typically, the interest rate on that is prime to prime plus a half. So it's a floating interest rate. And you only have to pay interest payments on it. So if you borrow the money, all you're obliged to do is pay interest. You don't actually have to pay any principal down. You can do that whenever you want. So for some people, they're like, they borrowed it, they wanted to use it for some short-term investment, they spent that money on something, maybe they get paid back, or they get an inheritance, or they sell a property, they pay it all off, there's no penalties, there's no additional cost for doing that.
And how long does that last? Like once you get assessed and you get it, how long is it good for? Forever.
Yeah, forever until, let's say for instance, you obviously sell the property and then it goes away. In some cases, if let's say it was you and another partner and something happens, you separate, then obviously that will change. They'll have to you'd have to requalify for it on your own. So there's things like that. But assuming nothing changes and you stay with the same lender, that's another important element, right? So assuming you stay with the same lender, then you should retain and still have that product. So for example, if you're retiring, if you're planning on retiring, what you might want to do is before you retire, qualify for the maximum line of credit that you can get, retire, and you'll still have access to that line of credit even though your income has dropped because you're in retirement.
Right. Yeah, so it's kind of like it could be used for emergency. Of course, we don't necessarily always encourage people to incur more debt, but but if you have that ready, for example, your roof is leaking, you can just say, oh, I don't have the cash flow right now. I need to borrow some money in order to fix the roof. So that's also an option. What might be some of the bad things if you have that ready and then you've seen people might have gotten?
Some people have gotten into a tendency to just keep getting more and more line of credit. So basically increasing it year over year over year because historically, Vancouver real estate or British Columbia real estate has always gone up. So they're like, well, I'll just keep increasing it. And there's some less scrupulous brokers or lenders that encourage that behavior. And the problem is that you continue to increase it, you continue to draw from it, you're not planning on paying it off, and you're using it to just pay off your credit cards. What happens is you will eventually run out. And you got to pay the piper at some point. So that interest continues to grow, continues to increase. Eventually it gets to a point where your mortgage and your line of credit is getting like a bit too much for you. And if you're not on top of it and you have no more ability to increase the line of credit, you may have to sell your home. So we want to avoid that. Like the intention of the line of credit should be emergency expenses, not to just pay off your credit card balances from that, all of that shopping spree that you did over the course of the Black Friday. And you want to use it for smart investments. So if, let's say for instance, you're like, hey, I'm going to use this to buy an investment property that I'm going to generate income from, and it's going to help me with covering this, and you've discussed it with your financial planner, your realtor, your mortgage broker, maybe that's a great use for it. Buying that Land Rover you've always had your eye on, maybe not.
Well, but if you're going to borrow money, again, like borrow responsibly, kind of like with credit card, right? Because like if you're going to finance a car, that's still probably a good way to go about it compared to like...
Yes, but when you finance a car, when you get a loan to buy a car, even though the interest rate might be higher, there's a plan to pay it off, right? So it's like, pay it off over 5 years, pay it off over 7 years. The line of credit, you have to be disciplined, right?
Yeah.
So if you know yourself, if you're like, you know what, I know that if I can only get away with paying interest on this and I have no requirement to have to pay this thing off, you may be better off. And you can also, so I should mention, you can also with some lenders, so this is where I can come in. But this is something that you can do with some lenders where you can break off a piece of the line of credit. So like, let's say you're like, I need $50,000 to buy a new vehicle. You can take $50,000 out of your line of credit and make that a loan and amortize it over whatever time you want to pay it over, right? So you're like, okay, I'm going to buy this car. The car company or the financier for them, they were offering me a rate of 7.99% for a 5-year and a 5-year amortized loan. Well, maybe you can use the line of credit, pay a rate of like 5.25%, and put that over 10 years, right? So longer time duration, payments are lower than what it was, plus your interest rate's lower. You're comfortable with those payments, but you know that each payment that you're making is actually going to pay it off.
Yeah. So with a, like for example, a car dealership, their financing structure, can you pay it back early? Is there any penalty compared to if you utilize the equity loan? And
most you can pay off financing. So like if it's a loan, you can pay it off without penalty. There's some minor administrative costs that they pay, but not like the typical mortgage penalties that you see. If you're leasing, however, totally different story. We've had it even with some clients where you can't get out of a lease. Like even if you had the money to pay it off in full outright, the leasing company doesn't allow you to do that.
Yeah.
So that's something that you need to be cautious of. And because if you have to get out of a lease, that's a completely different thing that could be very difficult to have to get out of. You have to transfer it typically to somebody else to take it over, and who really wants that? So, but if you, let's say you bought a car a few years ago, you're also buying a place now, you've got equity, you can use that to pay off any car loans. Or maybe you were leasing a car and it's like now you're getting to the end of the lease and they're giving you the option to buy it out. Great, this might be a good option for you to pull the money that you had out of the equity in your home to buy out your car because it's such a good deal.
Yeah. All right. So the point, I guess the takeaway in this episode is like you already took on the responsibility of owning a home. So be responsible in terms of budgeting for kind of ongoing costs for your home, as well as you're going to take out home equity, which can be an asset that you need to kind of maintain your home or actually just for the lifestyle that you want. You still got to be disciplined and responsible just to make sure that your home is actually protected. So then just like that, we have reached basically the end of our destination in terms of home buyers money map. And we have demystified a lot of the things to do with down payment, understand the ongoing costs. And our goal throughout this series has been to kind of equip you with the financial knowledge and confidence to make your dream home a reality. So I'm very grateful for Damon from Pilot Mortgage Group here with me to kind of share his invaluable knowledge. And if you have lingering questions and want to discuss specific neighborhoods or you're ready to look for your next home, please don't hesitate to reach out to me. And of course, again, if you have any home financing needs, reach out to Damon. And until next time, have a good one.